Welcome back to Everything Money. In this video, you will learn about Discovery and its stock. We will go through a fundamental analysis of the financials using our software, and we will move toward what you should be paying for Discovery moving forward using our stock analyzer tool. If you want to trade Discovery at a quicker pace, we'll head over to Mo. He will show you all the charts and all the trends for trading. But first, why should you watch this video? I bring your questions about Discovery, their merger away from Warner Media and AT&T, and how this will affect you as a shareholder moving forward. I bring these questions to a couple guys that own and operate over $100 million in real estate, multiple businesses, and stocks, and they will guide us through the process of investing in a company like Discovery. Paul, I'll fill you in. What are your initial thoughts about Discovery?
Thank you, Seth. First off, follow us on Instagram, Everything Money Investing. It's our new Instagram account. And then follow us personally, all three of us, because we really can't stand seeing the Everything Money one go up and not our egos go up.
Yes.
Guys, so Discovery is an interesting company. So let's go to our 8-pillar, our website. This is our exclusive software, 8 Pillars tool. Let's go to Discovery. If I could type, that'd be great. I'm typing like Mo right now. So guys, this is the 1-year chart of Discovery. Wasn't this part of the whole...
Yes.
What was the name?
Bets. Wall Street Bets.
No, not only that, the Archegos
squeeze.
or whatever. Was that part of the Archegos? What was
Archegos?
that? Archegos, sorry.
So the rise, there was a lot of the rise that had to do with Wall Street Bets, and the fall had to do with Archegos.
Right.
They were in it.
So I remember last year, Seth was like, I'm killing it. Look at this. Like, look at my stock, because this was a
little book that beats the market, magic formula stock.
Correct. And everybody was killing it. It went from $20 a share to freaking 75 or 80, and then it collapsed. So guys, this is what's happening with Discovery. Discovery, there's a big company called AT&T.
Heard of them, yes.
AT&T is struggling. They're spitting off their Warner Media assets. They're taking that part of their company and they're siphoning it off. They're siphoning off a lot of debt too. And they're merging it with Discovery. It's going to be a new company, I believe, called Warner Media Discovery. I don't know how they came up with that name.
That's right. Very ingenious.
Somebody's 4-year-old child just said, why didn't you call it Warner? Anyways, this happens a lot. This is becoming a new company. That's not going to happen until middle of 2022. My understanding is, if I read this correctly, and I could be wrong, AT&T shareholders are getting 70% of the new
71,
company.
Yep.
And the Discovery shareholders are getting 29% of the new company.
So it's really like Warner Media is being freed from AT&T and picking up Discovery.
Because there's a big fight right now for content. Mm-hmm. And Warner Media's got a lot of content. Don't they own like HBO and all these other ones?
You're right.
And Discovery's got a lot of content. I believe Discovery, who has subscribers? I mean, Discovery has subscribers, guys. They have like 20 million subscribers, something like that, who pay. This is going to be an ongoing battle in media, is who has the best content. Netflix spent $17 billion last year on content, right? So it's going to be a battle for content because everybody's going to want everybody to subscribe to subscribe to my media, blah, 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 blah. It's going to be much better than owning cable and then seeing 3,000 channels you don't use, right? Mm-hmm. So this is the new plan for the company. We don't have the financials on the new company yet.
If you go to Paul's house, he sits in a lonely room and he watches the channels where the nuns are just praying. That's what he's really into. Okay, Paul.
I stroke my cats. I go like this
Dr.
with my
Evil?
hairless cats.
All right, get into the financials of Discovery.
So what we're going to do now is we're going to use our 8-pillar analysis to look at Discovery. This does not mean that you should 100% own if we like it or don't like it. We have to wait for the new company's financials to come out. Okay? So we're going to use our 8-pillar analysis to do this. First off, Discovery is a $14 billion market cap company. Our first pillar, we want the 5-year PE to be less than 22.5. It is only 14.5. That's a check mark.
Very nice.
Very, very nice. Second pillar, we want the 5-year return on invested capital to be less than 9%. Greater than 9%. Mm-hmm. It is 7.8%. That is an X. Okay? That's fine. Now we go over here. There's no dividend yield. Their 5-year average free cash flow is $2.3 billion. Last year's free cash flow was $2 billion, so it's pretty consistent. Pillar number 3, we want revenue growth over the last 5 years. So we go to the income statement on our exclusive software. Mm-hmm. 5 years ago, $6.38 billion. Last year, $11.4 billion. That's a check mark. Almost a doubling.
Wow.
Now, I want to look at the cash flow statement at some point and see how much that was from acquisitions versus organic growth. That does matter, folks. You don't want to find companies that just grow through acquisitions.
Pillar number 4 is profit growth, Paul. Keep going.
So profit growth, 5 years ago, $1.1 billion. Last year, 1.24. So this is a concern of mine. Their revenue almost doubled and their profits only up 10%. That's a problem for me. Look at the last 10 years, Seth. They're barely up in the last 10 years.
They're not doing anything.
Actually, in 2019, they had $1.9 billion in profit. Now they have 1.24. Mm-hmm. Okay, pillar number 5, shares outstanding. Guys, this is the silent killer in stocks that people don't realize. We want shares going down. If a company has 100 shares outstanding and you own 10 of them, you own 10% of the business. If they issue 20 extra shares, you now own 10 out of 120 shares, or 8.3%. You've been diluted. You get a smaller piece of the pie. If they buy shares back, let's say they go from 100 to 80, you now own more of the business. You now own 10 out of 80 shares, or 12.5% of the business. You've been rewarded for sticking with the company. So we go to the bottom of the income statement on our exclusive software. Oh, look at this. 381 to 506. That's an X. But look at this, Seth. It went from 381 one year to 523. What does this tell me?
You know, I was just going to say, with that huge spike, wouldn't they just be screaming we should just sell off a bunch of shares with that huge price stuff? I mean, when
That was last year, though. But yes, you might be right. This is 4 or 5 years ago. Why did they have a big jump? This screams acquisition to me.
Acquisition central.
So I'm going to skip to the cash flow statement really quick to see if there was an acquisition back then. $9 billion. Look at your Uncle Paul being smart. $9 billion acquisition. Negative cash flow. Boom. So they did make a big acquisition. Okay. Pillar number 6
Yep.
is our debt ratios. Now, guys, companies with less debt last longer periods of time. Look at every company like an individual person. The more debt you have, the more likely you are to go bankrupt or have financial trouble when recessions hit. Same with companies. So how do we do it? We go to our main metrics page. We scroll. We find the 5-year average free cash flow. Seth, what metric do I like to multiply that 5-year average free cash flow by? What number?
5?
Yes.
They want to be able to pay off their debts in 5 years.
$11.5 billion. So we want their long-term liabilities to be under $11.5 billion. Seth, where do we find the long-term liabilities?
Oh boy, this is going to be on the balance sheet?
Correct. So we go to the balance sheet in our software.
Thanks.
We scroll to the very bottom. $17.9 billion. So I will say this. When I've read about the new company that's coming out, I believe AT&T is trying to siphon off a lot of their debt to this new company. This new company could have a ton of debt.
Yep.
And that's something to be concerned about going forward. So it's an X on the debt here. Let's go to the free cash flow. Now, guys, free cash flow is a lot harder to manipulate than earnings. Earnings can be manipulated because of SEC rules, accounting rules, careless CEOs and CFOs, et cetera. So we like to look at the free cash flow. Free cash flow is cash from operations less your capital expenditures. And you can do one of 5 things for them that Seth's going to tell you about right now.
Why do you do this? Is not helping the show. They buy back shares. They pay a dividend. They reinvest in themselves. They make acquisitions, and they fund Naked and Afraid, the show I really love.
Correct. They pay down debt.
Oh, pay down debt, of course.
So the reason I asked Seth about these things, guys, is because Seth is the average person. And if you're confused, it's going to take you Seth has watched 1,100 videos of this, and it's been harder and harder for him to understand it as well.
It takes it's a repetitive nature of understanding this.
This is a process. Don't feel embarrassed. Don't feel alone. Maybe more on that later, but don't feel bad because you didn't get this in the first try. Just keep over and over, and you will brainwash yourself in the right way. So, cash from operations less your capital expenditures. Your Uncle Paul here, who loves you so dearly, come give him a hug, has added this line here, the free cash flow line, to the cash flow statement. Nobody else has this on their software for a reason. It's not an official line. I've added it right here to the software. 5 years ago, 1.59 billion. Last year, 2 billion. That's a check mark. Our final metric, we take the average of the last 5 years, multiply by 20 for a value of the company, $46 billion versus $13 billion. That's what the company is today. That is a massive check mark. Does that mean you go out and buy the company right now?
Yes.
Not necessarily. It's just a starting point. Remember, a slower growing company should have lower multiple than a faster growing company. What we're going to do now is we're going to use our most popular item, the stock analyzer tool. The stock analyzer tool is right here on the software. What we're doing here is every investment is the present value of all future cash flows. We don't know what happens in the future. We have no idea what's going to happen in the future, but we can make assumptions based on our research and things like that. So now I'm going to go to Mo and Seth and say, guys, you guys have read about this company. Give me growth assumptions in the future. If this company weren't to merge with Warner Media, let's look at the growth assumptions of the company.
Weren't to merge, because I was going to say, with all with all the stuff going on in the future, I don't know what to say. Like, isn't this kind of up in the air about their...
It is, but let's say the merger doesn't happen. And anything can happen. Somebody has a bad bowel movement and goes, I'm done with this.
Okay.
We still want to look at a company by itself from a 500-foot view. So,
Okay.
revenue growth. Now, keep in mind, guys, they made a big acquisition in these last 10 years. So, give me some revenue growth numbers for Discovery.
Oh,
And our goal is to be conservative.
7, 8, 9.
I was going to say the same. I was going to get closer to 10, but okay, 7, 8, 9.
I'm actually going to go lower. This is why I come up with low numbers. This is why people say to me, you never buy stocks. I always go low. My opinion is going lower. Our job is to find, there's 10,000 stocks out there. Find the 20 to 40 that work for you and then buy those. But either way, 7, 8, 9. What about profit margin? Profit margin wouldn't have been affected as much by this merger.
I mean, it's the 10-year is 13%. If I'm just,
9, 10, 11?
yeah, that's fine.
9, 10,
I mean,
11.
yeah, I would even go if you put the high side at 13, that would be fine.
Are they going to get thinner, Paul, or
I don't know. I really don't know. I think 9, 10, 11 is fine.
I think the only way the profit margin sinks is if they come out with their own studio and start making their own stuff and investing more into that, and it starts bringing their profit margin down on selling.
But if they have high margin in subscription business,
True,
it could
could
count for
offset
that.
it. Exactly.
So guys, free cash flow margin and the profit margin are very different here. Look at that. Very big differences in free cash flow margin. So give me some free cash flow margin ideas.
What did I say for profit margin?
9, 10, 11.
Maybe just double it.
So you're saying 18, 20, 22?
Yep.
How do you think about that, Seth?
I agree.
All right, give me a PE.
This one I'm going to
It's
be
11
low.
right now.
I mean, 12, 13, 14, 12, 14, 16 high side. I do think that this is probably undervalued right now, but I don't think there's much more room to go run on it.
Okay, so I'm going to put in 12, 13, 14 for PE, and for free cash flow, I'm going to put in 10, 12, 14. Still higher than they are today. Let's hit the analyze button and see where we stand. This is going to be an absolute buy. Yeah, look at that.
Yeah.
Now, guys, does that mean you're going to go out and buy this thing?
What are some of those numbers, Paul, for folks on the
These
phone?
are so based on the high assumptions, middle assumptions, low assumptions, this is the stock prices you should be paying. The thing I like here is the stock is pretty close to the lowest of all the numbers on this.
Oh, so $30 on the mid and 36 on the high?
Yeah. 24 is the low and 75 is the highest
75 is
number
high.
we get here. So it's worth somewhere between there based on your assumptions. Now, I will say the debt levels scare me on this company.
And the path forward, you said they're going to transfer a lot of their debt over to them.
Yeah, this kind of concerns with the company. There's a lot of debt in the company. Now, can it support that debt with high margin subscriptions? Sure. If they drive that revenue up more and more and more, there's going to be the gross, because look at the gross margin of this company. The gross margin, guys, is for every additional dollar in revenue, how much goes to the bottom line, how much goes to the profit? 60%. So if they doubled their sales tomorrow, theoretically, if its sales dramatically doubled tomorrow, their profit would go up with 60% of that extra money would go to profit. That's a huge number. So they have a high profit margin business. So can it justify a higher multiple or higher debt? It can justify higher debt if they have a good profit margin, gross margin, leading to a better bottom line margin. But their bottom line margin is only 10%. It's not that great. So I'm apprehensive about Discovery. We've done other videos in the past, but factoring the debt, I didn't remember how bad the debt was. So for me personally, if I'm deciding on whether to buy this company individually versus as part of a process like Seth did, I'm probably gonna be a little bit more apprehensive. But this software has helped us do all this.
Yeah, if you've only ever bought ticker symbols and hope they've gone up, if this resonates with you and you like the software, we can show you how to get it right now. Go ahead, Paul.
So we created the software because our original subscribers wanted to be able to do their own research and analysis without waiting for us to make more videos. So we created the software just for them. What's included is everything you saw here, including our amazing stock analyzer tool. You get 30 years of financial data, access to Seth Moe and I. You get exclusive daily content, 2 or 3 videos per day sent to you only through our software and our mobile app. This software back here is on the App Store and Android, so you can use it on the go. Everything there is included. All the extras, retirement calculator, real estate calculator, everything here is all going to be included in your subscription. But most importantly, if you feel alone out there, which a lot of our subscribers do, they joined our community with over 6,000 people, and now they can talk to everyone around the world 24 hours a day about their own investment ideas to bounce things off each other, talk about things. You're no longer alone in your own island. You can have these conversations with everybody. This is all available for only 90 cents per day. This is a no-brainer, 90 cents per day. If you're just able to either increase your returns by 1% or decrease your losses by 1%, this could lead to hundreds of thousands, if not millions of dollars a year. And you can also fire your financial planner, saving hundreds of thousands of dollars in your lifetime. So sign up, everythingmoney.com, or Patreon. Either one gets you access within minutes. The benefit of everythingmoney.com is we do not charge sales tax yet because of our size. So sign up, 90 cents a day, less than a cup of coffee, no brainer. Make the best decision if you are serious about your financial future.
And if you're looking to trade Discovery at a quicker pace, you can join Mo in the Bid and Ask Nation. He'll show you the charts right now. Mo, what's going? Oh, look at that uptick. What's going on over there?
So it's ticking up, but let's look. We have 50% stock here, so we have to remember that there's going to be this resistance in the middle. So
I disagree. Look at the way that puppy can run, Mo.
I don't disagree with you there because I just drew a line at about $53, and this is at $27. So if this thing can move into the sweet spot, I do think that it can move to this level. It'll eventually hit here, and I think it will fall back down. But we're going to see where that resistance level is going to be created. It's going to be somewhere between $40 and $50 a share.
When this merges, do you start frothing at the mouth and getting like...
You know, I get excited because the news comes out and people start getting excited about the stock, and they start moving towards it, which means volume, buying volume, which means the stock price starts going up. So that's the reason that I start frothing at the mouth. But keep a watch on that stochastic. Let's see. You know what? Because of what this thing does, it cannot break over moving averages. It has finally done that, but you notice these are pretty weak candlesticks. I do think that this thing is going to probably fall back below the 100-day moving average. That, with declining volume, I do think that's going to happen. So, Seth, there's a lot of resistance that it needs to get through. It's going to need a lot more consistent excitement to break through that 100-day moving average and make that move to 200 and beyond. So, sounding like Buzz Lightyear. The other thing you can do is come and day trade it if you want to. This is a very affordable stock to day trade because of the price point. And if you just get above 80% here, look at these runs that you can make in a day. It does make consistent runs even today. This is not a bad short today. It's not a great short, but it's not the worst short. So there's ways to make money on this thing, a lot of different ways from a long-term perspective, daily perspective, and day trading perspective. So if this charting speaks to you, come and join me in the Bid and Ask Nation. You'll get access to all of my Trading 101 series videos, which teaches you everything you need to know about this. You get access to the Employed Trader series, which is 6 stocks that I go through every single day that help you guys that are working trade to be more active. You get my monthly seminars that I do once a month, usually on Saturday mornings. If you want to come and learn how to trade and make money, come and join me in the Bid and Ask Nation.
That is our take on Discovery. We will certainly update you on the stock, the financials moving forward, especially after the merger. An interesting company I've owned in the past, and maybe we can own in the future. So, yeah, thanks for watching. Watch more videos. This is a language we're speaking. If it resonates, we welcome you into our community. Fondle the thumbs up on the way out. We'll see you next video.